welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Today's topic is about the tax advantages of owning your own business. And these tax advantages, a lot of them I've applied in my own personal situation, maximize my deduction, taking the tax credits that are available exclusively to entrepreneurs. These tax advantages and strategies available, they're not loopholes. They are designed specifically in our Income Tax Act to encourage Canadians, average Canadians, to take risk, invest, and create economic benefits to contribute to our society. So I want to share all these tax strategies available to all small business owners in Canada with you so that you can make sure to maximize your deductions, minimize the taxes, and have maximum amount of money and reward for all the hard work that you've put into the Canadian economy. But before I get started, make sure you give us a thumbs up if you like our video and hit the subscribe button below if you like to stay on top of the latest tax tips. With that, let's get started. First thing first, the first benefit that you get as a small business owner is your tax rate. So let me explain. Well, our Canadian personal income tax system is a progressive tax system. What it means is that the more money that you make, the more taxes that you would have to pay. Now, if you earn $150,000 employment income, the $150,000 is not charged with a specific flat rate. Rather, the $150,000 is being divided into different tax brackets, different chunks of income. The higher the tax bracket, the higher the marginal tax rate that would be applicable to that particular tax bracket. Now, let me use some examples to explain. I need to pull that up. So in Ontario alone, between $0 and to about $15,000, you do not need to pay any personal income taxes. That's called personal tax exemption. But between $15,000 to roughly about $53,000, you will have to pay 19.55% tax, or roughly about 20% tax. Between $53,000 to $57,000, you will have to pay 24% tax. And between $57,000 to $93,000, you have to pay 30% tax. And then for someone who's making $150,000, we have to keep going, doing the math, taking the tax rate multiplied by the corresponding tax bracket, the delta due in that particular tax bracket, and then sum them all up to come up with the total tax payable for the year. So for someone who's making $150,000, you would pretty much roughly need to pay about $50,000 of tax if you live in Ontario. Now, if you are someone who's making a lot more money as an employee, anything above and beyond $253,000, you would need to pay all the way up to 53.53% tax on any income that you earn above that $253,000. So yes, if you earn anything above and beyond that $250,000 mark, you are going to pay more to CRA than what you would get to keep. Yeah, that is so sad. Now, on the flip side, as a Canadian small business owner, what you can actually do is to take advantage of the tax rate that's available, in the beneficial tax rate that's available exclusively to a small business corporation. Now, when you operate your small business in a corporation, the first $500,000 of net income meaning you could receive $1 million and the cost of sales is $850,000. So you net $150,000 is only the net amount that you get taxed on. And when you get taxed on that $150,000 within a corporation in Ontario, the tax rate on that first $500,000 net small business income would be taxed at 12.2%. 12.2% on any given day is better than what we see on the personal income tax side. So that's where the difference is. Now, for someone who's earning that $150,000 net small business income in the corporation, that person would roughly need to pay $18,300 of tax inside the corporation. Corporation, as we all know, is a separate legal entity. And what it means is that when the shareholder, so you're the small business owner, the shareholder, the owner of the corporation, draw the money out from the corporation, either in the form of salary or dividend, you'll have to pay another layer of personal income tax. The key here, though, is not to draw all the money out. You draw enough money out into your personal name to support your personal living expenses, and then leave the rest of the money inside the corporation, because you get to be only taxed at 12.2% tax rate. So you want to leave the maximum amount of the money within your corporation, so you will be able to defer as much taxes as possible for reinvestment within the corporation, and also for you to invest for your future self, or for you to retire using that extra money. Now, for someone who earns $150,000 employment income in their personal name versus someone who earns the same $150,000 in the corporation, paying the corporation tax and assuming he doesn't need that money to support the lifestyle, you're talking about a $32,000 of tax deferral, $50,000 tax payable in the personal side versus $18,300 in the corporation. A $32,000 tax differences is substantial. Now, then it comes down to the second point. Because you can operate the business within a corporation, which is a separate legal entity, like we just discussed, that additional $32,000 that you are able to save, that you get to keep within your corporation's pocket, you would be able to use that $38,000 tax deferral saving. Well, it's tax deferral, it's not really tax saving. You eventually need to, at some point, need to pay some taxes when you withdraw it to your personal name. But at this point, you have the flexibility. You are in control. You're in control of that $38,000. And you could use that $38,000 to invest for yourself. You can reinvest in the corporation. You can use it as your rainy day fund. So then all you need to do is you can use that $38,000 to even avoid bumping yourself into the higher tax bracket, like I mentioned earlier. So that's the tax flexibility that you get as operating your own business and being your own small business owner. Number 3, income tax smoothing. Now, the benefit of owning your businesses inside a corporation is that you are eligible for the 12.2%. And the second reason why you want to own the business in the corporation is because it's a separate legal entity. What it means is that you have the choice as the shareholder or the owner of the business. You can choose not to take as much dividend annually from the corporation. So you can play around with timing, so then you can minimize the amount of taxes that you need to otherwise pay in your personal tax return. And so you can maximize the tax saving that way, because in every single year, every Canadian tax resident would be entitled to those low marginal tax rate. Like first, $53,000 is taxed at 20%, and then between 53 and 57 is taxed at 24%. We talked a lot about that earlier. These tax rates, these low income tax brackets are available by every single year to every Canadian tax resident. So if you manage to pay yourself $50,000 in year 1, and then another $50,000 in year 2, you are keeping your personal tax income to a very low tax rate scenario. Versus if you, 1 year, you earn the entire $100,000 lump sum, then all your tax income is being added. And so there is more tax that you will have to pay on your personal side. And that's the benefit of having a corporation earning your small business income, and you can choose to smooth out your income. Let me use a real life example to explain. Last year, I sold a property in my personal name. I've owned that property for years and years, over 10 years. And I've had some accumulated gain on that property when I sold the property. So I know that that capital gain is coming in, and I have to report it in my 2024 tax return. But because I already have that capital gain reporting in the tax return, I'm already padding up my personal tax income. So my personal tax income for the first $57,000, we talk about 20%, 23%. If I continue to draw the same amount of money out from my corporation, that additional money that I draw out from my corporation as salary or dividend would be taxed at a much higher tax rate. But because I run my business within my corporation, now I have the flexibility and choosing to defer and not opt out of drawing dividend from my business. So I don't have any dividend income from my business this particular past year, but instead I essentially only have the capital gain reported. And next year, when I don't have the capital gain because I'm not selling another property, in 2025, I can continue to draw the money out from my corporation. So I'm minimizing the amount that would be subject to high personal tax rate because I operate a business and I operate the business in a corporation. Number 4 reason why you should set up a corporation to own your business and why you should have a business to begin with is the income splitting opportunity available. Well, I explained earlier, you can smooth out the income between you and your future self. You would also be able to split income with your family members, provided that you have proper documentation available to substantiate the amount of work that's being done by these family members, lower income family members. And one of the most powerful things in Canada is that every single tax resident, every single year is eligible to a low set of marginal tax rate. And we went through the low marginal tax rate from 0% all the way to 20% to 29% to 26% to 31%. Everyone is eligible for that same tax bracket. So if you have someone who's working in the business for you, you would be eligible to distribute some cash, some salary or dividend to these people and lower your overall family tax liability. So that is only available, obviously, if you are operating a business with the proper structure and proper documentation. You would still be eligible to do income splitting and lower your whole family tax liability. Now, the 5th benefit of operating your business, small business, particularly if you operate your business in corporation environment, is when you sell the small business, and if assuming that you qualify, your small business qualify, you would be eligible to shelter about $1.25 million of light capital gain. So meaning that when you sell your business, you sell the share of your business from you to someone else, and you make $1 million, the entire $1 million could be completely tax-free. And that is almost unheard of. So operating a business and selling the share of the business would allow you, assuming the business qualifies and meet the definition required in this specific income tax act section, you would be eligible to sell shares for up to $1.25 million tax-free. And there are some tax planning strategies available if you sell more than that, and you would be able to even lower the amount of taxes and multiply that 1.25 million tax exemption available, capital gain exemptions available to you. So you could even save more taxes if you sell more than the $1 million of your shares. Now, the 6th tax benefit is the tax credits and incentives available for small business owner. As I just wrap up my personal, my corporation tax returns, I'm also taking advantage of some of these tax credits available. For example, I hire many students from universities to help me with my tax season, and by hiring university students through their co-op program, I would be eligible to lower my tax rate. I would be eligible for the co-op education tax credit, and that gives me tax reduction because the government wants to encourage small businesses to hire students from various programs so then they would be more trained for their future jobs. So we hire many students to help us, and by hiring these students, we are eligible to claim the tax credit, which lower my tax liability. And there's also other type of tax incentive available, including the scientific research and experimental development tax credit. If you are doing research and you are developing some new technology or a process, chances are probably you would be eligible for this tax credit, and it would be paying you a portion of your salary back. And one of our clients is not needing to pay any taxes for a number of years because of this particular tax credit. And there are other digital media and innovation credits available. There are a bunch of other tax credits and tax incentives available within these programs that only small business owners would be eligible for. The 7th tax benefit operating your own business is the pre-tax deductions that you are going to get versus the tax credit. Now, using an example to explain, let's say you are donating and you're making a donation. Normal employees, when they do a donation, you donate $100 to a charity of your choice with the cause that you want to support, and then you claim it on your personal tax return. When you claim it on your personal tax return, the benefit that you are going to get from that $100 is that you're going to get a tax credit back, and the tax credit that you are getting is about 20% of what you are donating. So which is about $20 in this example. Versus if you operate a business and you operate a business within a corporation environment, donation is actually a business expense, and you can offset it against your income dollar for dollar. So if you make the money and essentially in the corporation, you deduct it against your business income, you don't even need to pay any tax on the income that you earn at all. That means if you are reporting $100 of net income in the corporation, you donate that same $100, then you pay 0% tax on it because you net zero and within the corporation. So that's the benefit of owning a business within the corporation, because certain expenses you would be eligible to deduct, offset against the business income that you're receiving, and you don't even need to pay tax on it. Versus if you do the same thing in your personal name, you would not be eligible for it. Another example is the health spending account for medical expenses. If you are setting up medical expense health spending account for your corporation, particularly for employees, and you would be eligible to deduct these expenses again as a business expense. You don't even need to pay tax on it. So if you spend $4,000 on your kids' braces, and through the proper setup of the health spending account within your corporation, you would be eligible to claim that $4,000 as a business expense. Versus if you are claiming that same $4,000 on your personal income tax return as a medical expense tax credit, it would be a lot less effective because you need to meet the minimum medical expenditure requirement, and then anything above and beyond that, you would then be eligible to claim again a tax credit on it, which will result in a 20% benefit of whatever the eligible amount would be. So again, this is only available if you operate a small business within a corporation. Another example is the individual pension plan, sort of like RSP. RSP, for someone who earned employment income, you would be eligible to contribute to your own RSP. The amount of contribution would be deducted, offset against your taxable income, so you don't have to pay tax on that amount altogether. But imagine you're owning a business and you are owning a successful small business, and that individual pension, you can set up something similar to your RSP, except that this time you're using your business income to make contribution to your own pension plan. And once you make that contribution, you don't even get tax on your business income altogether. And the amount is really calculated based on what the actuary are saying, not just based on what the government are randomly saying regarding the RSP amount. So that is the benefit of having the corporation owning your small business. Now, number 8, I would have thought that I would mention this way earlier, but number 8, at least we're covering this now, it's about the writing off expenses that you would not normally be eligible to write off the expenses for if you are not having a business. Now, these include all the expenses that you incur for the purpose of earning the income, subject to many different exceptions within the Income Tax Act. But the most common ones would be your car expenses. If you drive your car to see clients, the mileage that you've incurred for the purpose of seeing your clients would be tax deductible. If you drive your car to scout properties, if you drive your car to visit a prospective client, or even seeing a referral partner, visit the manufacturing plant that does the manufacturing for you, all these mileage would be tax deductible. And if you structure it right, maybe a portion of the car can also be tax deductible. So there are lots and lots of tax deductions available if you use your car for the purpose of running your business. On the flip side, if you operate your businesses, a lot of businesses nowadays are remote and it's being run on a cloud basis. And if you operate your business from your home office, a portion of your home expenses would also be eligible for deduction. These are the things that you would not normally be able to deduct as an employee because even if you deduct home office expense as an employee, unfortunately, the type of expenses that you're eligible to deduct would be a lot more restricted compared to operating a business, a small business, and deducting that home office expense. Now that I've covered all of the top 8 tax benefits of owning and running your own business, if you like our video, make sure you hit the subscribe button below. Make sure you share this video with all the friends that also run a small business. Until next time, happy Canadian real estate investing!